Last week we talked about savings, and we had a really interesting discussion about how to start off with saving a little bit, the importance of budgeting, and once you have that little bit of money that you want to invest, where do you go with it, and what is the role of your financial advisor? So we're continuing the conversation, and my guests are back, Jaco. And Jaco, thank you very much for joining for this video. And maybe you guys can start us off with some of the names that are out there: annuities, exchange traded fund, right through to owning your own shares through an easy equities portfolio. What are the options out there for the small young investor just starting out?
Sure, there's a lot of options. So I think the most important thing is there's mainly two routes. You touch on the one is you're almost forced by your employer to have some sort of retirement vehicle like a pension fund, and then the alternative to that to someone working for themselves is a retirement annuity, which basically is the same principles, but you control where the money goes and how much. So that's on the official side. The discretionary side, there's thousands of options. So I think the most important thing to start is probably the different asset classes. I think if we can start there and break it down from there, that will be the easiest. So one of the asset classes, probably most well known, is equities or shares. And all that means you actually buy a piece, you own a share of a company. And a lot of people think the reason why you invest in shares is because of dividends. And that is, I want to say, 5% of the truth, because a very small part of your return is actually from the dividends that you get from your investment. It's actually the growth in the value of the share, or hopefully there's growth in the share that you pick. The problem is there's so many shares to pick from. So how do you decide which share are you going to pick?
Jaco, if I can interrupt you there, I know that on TikTok there's a lot of influencers talking about being financially independent through your dividends income, and they would talk a lot about the shares that pay the best dividends on the JSE, that sort of thing. But I think that's exactly what this field of research also shows, that that's the least of your worries. It's a bonus if you get a good dividend. It's looking for growth that's the key.
Yeah, just for the viewers out there, the average on the JSE, for instance, I think is about 3% over the long term that you get from dividends. So it's really a small portion, whereas the capital growth that you can expect is hopefully 10, 12, 15%.
And of course, if you invest in high yield dividend shares, it all just means that the company pays out a lot of the cash, so they have less to reinvest and grow themselves. So there's always a give and a take in this. And I think the biggest problem with dividends is that if you get it, it's very easy to spend. It's rarely reinvested. So your total investment does not grow.
And I suppose there's a tax implication as well. You're taking part of your profit when you receive those dividends.
Of course, when the companies pay out the dividends, they pay dividend withholding tax on that. So that reduces your money. And I think, Jaco, the next asset class is then property. So we all know property is a structure. It's built with bricks and mortar. And we often say that if you are a young person that's going to start to work, one of the things that you can decide is to maybe have 2 or 3 friends together and buy the property that you stay in while you just start off working. Share the expenses, share the installment, and that can be your first investment property. So if you move on, you have maybe finished your traineeship or your first years at the company where you are working, you can move on and then start to rent that property out, and it's your first investment property.
Waldo, I almost want to add, just go 2 steps back. If we talk investments, for the viewers again to understand, there's 2 components to investment. We actually touched on it when we talked about shares. The first one is you want capital growth, and the other part is you want some sort of income. And in some cases you only have one, the others you only have the other. But the combination of those 2 is what determines almost the return that you get from the investment. And we talked about dividends being 2.5%. With property, the rental income part or the income part is actually a much higher component. It can be 6, 8 to 8% after expenses. And here, and we can spend hours talking about compounding interest and reinvesting. And that's the most important thing with a property investment is that income that you get, you have to reinvest, because otherwise you get maybe 6 or 8% capital growth. You have 6 to 8% income, but if you don't reinvest that income and you live from that, you actually just reinvest the 8%. You have the growth on the capital. So for viewers, that for me is really important, that you realize you have to reinvest. Put that money somewhere else. Yes, it can be to pay off the bond quicker so that you can buy another property, but it's really important to understand that.
Okay, so that gives us equity and property. What are the others?
Basically, Waldo, you are left with, let's call it monetary investments, and that can be cash, fixed deposits, money market, and also there is bonds. And we're going to get really technical about bonds, and that is your field of expertise. Now we're going away from the financial accounting side, but basically that is actually companies borrowing money, or they are borrowing the money, lending it out, and you get a return on that. But it's very similar to any other cash or money market fixed deposit. What you get from that mostly is an interest component. But you know more than I do about that.
I only know that the secondary bond market is more complicated than I thought. Maybe something the listeners will recognize is the idea of the tax-free savings account. What goes into that investment? Is it a combination of these or a specific one of these asset classes?
It can be a combination of any of these asset classes. There are some limitations, and different companies have different portfolios, but you can actually have a tax-free savings account with mostly shares, and it can be all offshore. So there's so many options available. People often think that it must be cash or something like that.
It's only government bonds.
But there's so many options.
So in that sense, it's useful to think of that as also as a portfolio that you're investing in. It's not a single asset. It could be anything, and you can shop around amongst different companies and advisors for one that you prefer.
Definitely. And I mean, all the research, we are at the academic institution, the research shows that over the long term, a diversified portfolio normally will outperform a single asset class, because none of us know will property or shares or bonds do the best next year.
And is the same story true for exchange traded funds, unit trusts, those sorts of names that people know?
Yes, so unit trust is just a combination of the above that we discussed. So you can decide you want to have an aggressive portfolio, and that means it will probably be a bit more shares, equity, less cash, because the returns on cash are a bit lower, but the risk are also a bit lower. We actually have not discussed risk and return, but and unit trust is just a combination of that. Or you can just have a share portfolio of unit trust, and in that unit trust, the asset manager decide on the different shares that you want to invest in, and then it can be a combination, local, offshore, local and offshore. So really unit trusts, even retirement annuities, pension funds, all of those vehicles basically invest in those asset classes, just in different ratios.
And you mentioned exchange traded funds. When they originated, it was mostly equity, and you could buy equity or shares with that. But they have also now involved to incorporate bonds and cash, so you can have balanced portfolio exchange traded funds. So it's really, the choices are so many.
I recently read that you also now get a Bitcoin ETF. Which is sounds odd. You might as well buy the Bitcoin, but you can even invest in an ETF for Bitcoin.
It is.
Yeah.
And, sorry.
There will obviously be then ETFs also for a combination of different cryptocurrencies, where they have 50% Bitcoin and 30% Ethereum and whatever the case may be.
And I think the reason for the ETFs or the funds for Bitcoin and other cryptocurrencies is so that they can now be incorporated in a portfolio with other asset classes.
And I think the motivation for either ETF or even a unit trust, it just makes it easier for let's call it the general investor out there. I mean, few people have the knowledge, the skills, and then the time to actually go and study the market. So when you make use of a unit trust, you are trusting the fund manager to do a good job of that. If you don't want to pay the fees for that, because there's an admin fee or management fee for that, you don't want to pay the fees for that, you say, okay, I'll rather go for an ETF. The costs are lower, and that's why I would do it And
So
as
without
least I
the
get the
expertise, but at lower cost.
yes, and you get the performance of the market, because also research show that about 20% of the fund managers does beat the market, the other does not. So ETF is almost like the safe bet. You go somewhere in the middle.
I think you've already sort of touched on it. And I think when you mention all these options out there, that's already, I think, causing anxiety with a lot of first-time investors, thinking, how do I choose between these things? In terms of the principles, does this differ depending on your age or your risk appetite? How does that? Would you advise people over time to consider different asset classes or different vehicles depending on your age or your income or
Let me start with the official theoretical answer.
Perfect.
The academic answer.
So Waldo, I think the one thing is, what do you want to achieve with this investment? So if you want to have long-term growth, you have a lot of time, you can go more aggressive, or shares, that type of thing. The next is, what is your current financial position? So how much volatility, how much can you afford to lose? So if you are younger and you don't have a lot of money, you probably don't want to lose too much money, but you have time on your side. If you are an older person that have just retired and you have too little money to live off, you don't want to lose anything. You cannot afford to lose anything. And then the last component that you need to consider is your risk profile. So with how much risk can you sleep at night? And people differ. Some can handle all the ups and downs in the world and they will still sleep well. And others will get a panic attack after the first bad news. So, and if you take all of those into account, your goals, what your financial position is, what your risk profile is, that will help you to select the right vehicle and the right portfolio for your investment.
Yeah, we can actually have a long discussion. We should actually go back to risk and return, that whole thing about risk and return. But I don't know if you want to go
very briefly.
Okay, briefly. I'll do that. I won't let the academic explain that. But in simple terms, the higher the risk of an investment, or the higher is your expected return. And people should hear this, not the return, your expectation or the return that you require from the investment, so that you know there's high risk, so I need to make more out of it. But what people also need to realize is, with higher risk, there's a higher risk of actually losing your money, a higher risk of loss. And then we talked about right at the beginning, why do we invest? Either to get capital growth or to get income. And for me, that risk is actually measured in not getting one of the two. What is the chance that the value of your investment will actually decrease in value? If you buy shares, you can buy Capitec, or bought it 10 years ago, made a lot of money, but you could have bought African Bank and lost a lot of money, or Steinhoff. So that's good examples of that shows you the difference between, or not the difference, but the effect of either having capital growth or capital loss. And then on the other side, the income side, how sure are you're going to get your money? If you put your money in a money market, you're 95, 99% certain you're going to get the income, the rent, the interest from the bank. But if you have a tenant renting a property, you hope you're going to get the money, but not necessarily. And then if you go to shares with equities, there's no obligation on a company to pay a dividend. And if
We've seen it in COVID that some companies decided not to pay dividends.
So for me, that is the starting point, the whole understanding that relationship between risk and return. And over the long term, history has shown that certain things will, over time, make you more money. But like you said, there's ups and downs, and you should not lose sleep about that. But the other side of that is, for me, it's almost more important, is that people realize that if you put your money in the bank and you earn 3 or 4% interest, and that is below the inflation rate, you're actually losing money. I know banks like to use the term savings account. Savings account does not exist. It's just a money losing account, because at the end of the year, the purchasing power of your money actually decreased. That's the reality. There's very, very few savings account that beats inflation. Money markets are close to inflation. So the point I want to make is, yes, you don't want to take risks by not going in high risk investments, and we talked about crypto. I mean, that's next level.
But I think all-time high at the moment.
Yeah, but it's actually just as risky to put your money in a bank, and you're guaranteed to lose money over time. Value, not the money is going to be there, but the purchasing power has been reduced.
That's an excellent point. I think people don't appreciate how inflation eats into your buying power, and even if you don't consider yourself an investor of some kind, you need to make some investments, and really try and aim for a real return of, I don't know, 2, 3, 4%, just to make up for that difference. And as an economist, you would say, well, that's the average inflation rate. Your own inflation rate might be a bit higher even, and you need to make up for that in some way.
Yeah, just to add on to what you just said, Waldo, we normally say that a person that has a moderate risk profile would like to earn inflation plus 4 to 5%. And on the most aggressive side, we normally look at inflation plus 7%, because inflation plus 7%, I think, is about the 100-year average of the JSE. So the moment, and just to link back to high risk, the moment you get offered a return that's in excess of inflation plus 7%, which is the shares, you should ask questions about how big this risk really is.
I think that leads us on to another point, is to say, how important is your advisor, or if it's not a registered advisor that you're speaking to, what questions should you ask before giving your money to someone else to give you these guaranteed returns?
Yeah, I think the moment someone guarantees something, you should start to worry. That's the first thing. No matter who they are, if they guarantee something, you should worry. I think just looking at choosing a financial advisor, for me, there's a number of things that you have to look at. Most important, and maybe we are academic snobs, is qualifications. There are different qualifications out there, and you know that if a person is registered with a certain, let's call it institution, then you at least know that they have a certain experience, they went through certain
basic knowledge.
So that for me is quite important. And then,
so just to add on, in South Africa, that is the Financial Planning Institute, and advisors that are registered there are court certified financial planners.
So you shouldn't be shy to ask for someone's background on this. I can imagine if you walk into the office, you're slightly intimidated and you don't want to straight up ask, so where did you get your training? But that's actually quite important.
It is very important. And with that, and this is almost, I guess, unfair to someone starting out, but you would like to have someone with a bit of experience. You don't want the guy that just qualified and you are his first client. Everyone has to have a first client, but that should be under the guidance of someone with more experience. So for me, experience, and then get some references. Let that people tell you about clients of his. And I almost want to say it's better if it's people that you know that person's clients. I mean, if you go to the doctor, you're not just going to phone and see what is the cheapest doctor out there. You're not going to do that. You want a qualification, you want some experience and so forth, and it's the same here.
And I can imagine an experienced advisor is useful because they've seen the market up and the market down, and they know how to deal with both. If you catch someone at a good time, they've only seen the market up, and they are probably much more optimistic than they should be.
Very true, Waldo. I actually was just now thinking about some research that I read, that they said that people that have worked with an advisor for more than 15 years on average create 173% more wealth. But the most interesting portion, it was not because that advisor generated more return for them. It was because the advisors helped them to take the right decision and manage their emotions through all the processes.
There's a good bit of psychology in this. And we've sort of touched on it, but the red flags. South Africa seems to be plagued by schemes and not only Ponzi's, but different kinds of investment things that by the time you hear about it in the news, you're amazed that there's 4 billion in this. what is the aside from the guarantees, what else should you be looking out for and worried about when you put that lump sum that's hard earned in someone else's hands?
For me, it's simple. Yeah, you can just say, if it sounds too good to be true, it probably is. As simple as that. There's no way.
Like 20% a month.
if I almost want to say 20% a year is almost too good to be true, but I mean 20% a month, that's not the 40%. It just doesn't happen. And yes, I know if you invested in crypto 20 years ago, that's what you would have got. But if someone out there gives that to you, you must start to worry. And we can actually get into the why that happens, and it's just because people are desperate. They want a quick buck. So for me, the biggest red flag is just unrealistic returns. And the moment guarantees are added to it, you worry more. And my last view on that is, we talked about when we said talking about advisor, get someone that says, but have experience with that advisor. With these schemes, that's actually what happens is people will tell you, but I made this money, I can show it, and they show it to you, and they are just the lucky ones that got in first. So I want to say, even if people tell you, listen, I made money, don't put your money there.
And what relates to this, I think one of the things is, if it sounds really complicated and you don't understand how they're making this money, it's derivative instruments on foreign currency deals, on bonds combined with something else. I think, to my mind, that's also a red flag. If you can't make sense of how is the money being made, it's already a problem.
Very true. I've actually just this week read of one of the schemes where you can buy, it's on farming, and you can buy a share in a bird. and you can earn 6 cents or 60 cents a day. I mean, how?
So how is that value generated?
And then another thing is fake celebrity endorsements. If it's endorsed by people that's very prominent, but don't have a financial background, I mean, these people will know it's a regulated industry. They will not put their names out there for nothing. So be aware of that, because these fraudsters often use the pictures of celebrities to sell their schemes.
So if you see me giving financial advice, it's fake. It's not real. Talking about the economy is different. So, gentlemen, thank you for your time. I really appreciate it. It's been engaging, it's been interesting, and I hope we can get you back for more sometime early next year.
Thanks very much, Waldo.
Thank you.
So that was the Economics Weekly, talking about personal finance, saving, investment. If you found any of this interesting, please like, follow, share, and comment. We'd love to hear from you. Thank you very much.